Hi everyone, this is Madhu from madhufinance.com. Today we are going to understand about the role of Ecgc or Export Credit Guarantee Corporation of India and how we can utilize their services in credit insurance. A lot of exporters have this doubt, right? When I am exporting, how can the bank be happy that the money is going to come back and they will be feeling safe about it? A lot of exporters have this question about how the bank can fund their exports. So Export Credit Guarantee Corporation of India does three things. The first primary role of Ecgc, which is an organization under the Ministry of Commerce, the first thing they do is they give you credit guarantee insurance. So if you are exporting something abroad, in case the company that is buying from you goes bankrupt, they guarantee that they will pay that money back to you. So they are providing insurance cover. The second thing Ecgc does is so that because they provide insurance, the banks and financial institutions that will lend you money for your working capital will feel good that you will actually receive the money back. So they can actually lend you money without worrying about credit issues. The third thing that Ecgc has started doing these days is, so if you're investing abroad, either in equity or debt, they also provide insurance for that. So let's say you are an exporter and you want to export to a new buyer. It's probably a new country. This is the first time you're starting to export. You got a PO, then you go approach Ecgc. So they will evaluate the risk, the credit risk associated with this particular order. So there are two types of risk associated with the order. One is the country risk. So let's say this is a country in Africa. They want to know if there is going to be a political instability, maybe there is some issue with the country itself, which might impact the ability of you to receive money back in India. The second thing is the credit risk of that particular buyer or the customer who is placing the order. So because they have been operating, Ecgc has been operating in so many countries and have analyzed the credit risk of so many companies, they have a database where they will look in for this particular company. In case it is not there, they will try to evaluate this one and give a credit risk profiling of that company. So based on this country and credit risk profiling of that particular individual company, they will come up with an insurance premium for you. So typically what I have seen is it's somewhere around 0.1%. So it is 10 bips. So if you are insuring something, typically it will cost you 1 rupee for 1,000 rupees of exports. So the other thing that we have to keep in mind is Ecgc covers the payment risk, not the risk during transportation. So if you are sending it via a cargo ship and there is some issue, the ship itself, there is some fire, so that is not covered by Ecgc. So as an exporter, you must keep in mind that this only covers your financial risk. So if you want to cover your transportation risk, you will have to get a separate insurance, a marine insurance or a transportation insurance to cover that aspects of it. All right. So nowadays, Ecgc is not the only one doing this. There are a lot of private insurance companies are also involved in this. But either way, definitely get some kind of a coverage on your post-shipment money that you're going to be receiving. So this is primarily for your own safety. So if you're an exporter and the company that you exported goes bankrupt and they are not paying without insurance, that could wipe you out. So think about it and make sure you plan and have this insurance ahead of shipping the goods to the exporter. If you have any other questions, just leave a comment below and they will be happy to answer that.